Good morning, Roger here with Roger's $100,000 portfolio, $200,000 challenge with a 2-minute pre-market update. Well, today we are going to talk about the new Pros portfolio, and we'll review my original portfolio here in just a second. So basically, we sold off most of the positions that we had in the old portfolio, and we picked up a bunch of positions that they recommended, and we'll go through that in detail. But first of all, I owe you an explanation as to how they set up their portfolio and how their service works. So first of all, a little bit more of an explanation. So basically, each sector theoretically grow, stagnate, or decline depending on the market condition. What do I mean? I'm talking about market maturity. So you have growing markets like coming out of a recession. You have a mature market, which is what we've been in for the last 10 years up until this nice little hiccup here. And then you have a declining market. Certain sectors collectively increase in value in certain markets, and some stagnate, and then some decline in other markets. For example, in a growing market, consumer staples are steady, but they don't have the real big growth. But when the market is on the decline, consumer staples, those things that people just have to have, like right now, are really exploding. So what this company does is they have a list of stocks for each sector that they think that have the best potential gains. And within each sector, they make recommendations to buy or hold depending on the fundamental performance of each stock. What do I mean by fundamental performance? I'm talking about profitability, market share, and current share price in relation to the overall value of the company. So this firm that we signed up with basically has a team of researchers that research all these balance sheets and financial statements and they make recommendations. So their advice for diversification is to have 20 different stocks in your portfolio weighted to different sectors. And they recommend a certain number of stocks out of the 20 to be in each sector, and that's how they weight it. For example, the tech sector may have a quantity of 4, where energy may have 0 or 1. Again, they determine this weighting by the maturity of the market and the current trends. So understanding all this, what we've done is we filled out our portfolio according to their recommendations. Let's take a look. Now, for the purposes of our conversation here, I've taken all of their stocks that they recommended and put it into a spreadsheet. You can see the stock, you can see the sector that it's in, and in the current stock price. And I even put it in there, and from a technical aspect, what the previous high was, year-to-date high, so we can see what the potential is as a percentage getting back to where it was before. Now, with this as the platform, they send ideas, they call, or alerts as to when to buy certain stocks, when to sell certain stocks, or the changes in the weighting of the overall portfolio. And by managing this weighting in certain sectors and recommendations of certain stocks that they feel that have the best chance to go up long term, that your portfolio will realize the biggest gains. Now, the difference between our approach, which is more of a technical approach, and their approach is they get into a lot more detail. So remember, there are 3 categories. There's fundamentals, technicals, and behavioral. So fundamentals are the financials of a company, how strong they are, the kind of market share they have, what is their profitability, and technicals is basically, even in the strongest companies, you see cycles in the market in their share price over time. You would see one year, the share price would be high, and then it would dip down, and then it would go back up and down. Almost never is a share price perfectly constant over time. So that's what they call the technical analysis. It's just an observation of the share price over time. And then there's the behavioral. The behavioral has a lot of times nothing to do with fundamentals, the financials, or the technicals, which is the ups and downs over time. Things happen in the market. Coronavirus have sent, stalwart stocks in the tank, for example. The news can make a stock go up or down. Or if they're in a category and a company is doing really well, sometimes that bleeds over into other stocks that will take a stock higher or lower. So that's the behavioral aspect. And so what I'm doing in my portfolio right now is I'm strictly going off of technicals. In our portfolio, what we do is we look at the percentage, what it would take to get the stock back to where it was at the end of February, which is not that long ago. And so we feel that strictly a technical analysis right now is really obvious. You pick really strong companies, you're going to get back there. And so I have a lot of confidence with that. But these guys, the pros, they know how to make money, not only in just this market, but in a regular market where you don't have all this behavioral stuff going on, or the coronavirus or whatever. What happens when you don't have all that big news? How can you beat the market average? Okay, so let's discuss this for a second. So what is the market average? Over time, historically, the market will go up 10% every year on average. All right, some years it's 15%, some years it's 5%, but the idea is over time, historically, the market goes up 10% every year. If you have your money in the stock market over a long period of time at 10% per year, which means your money will double every 7 years. Not bad. So the idea is the market is, when compared to all the other investment types, yes, there's more risk in that there's more volatility and ups and downs, but it is the greatest return of your money other than you starting your own business and doing your own thing. So here we are. We have the competition with my purely technical approach, which we'll call primitive because it doesn't take into consideration all those other elements. And I think what we're doing is we're just taking this primitive approach just for the short period of time because of what's going on in the market. And it's the best way that a primitive person like me that doesn't have all that I don't have the time to research all those the fundamentals of a company, because I do normally have a regular job, I can still make a lot of money in all of this. So that's the hope, and we'll see where it goes. We still have some balancing of the portfolio. As you'll see, as you can see, we only have 12 of their 20 recommended positions right now because we still have several positions to get out of. But we are probably 70% there, 12 divided by 20, whatever. You get the idea. So I'm looking for opportunities to get out of what we had before and back into there. And you can see in the portfolio what happens. So we'll see over time, over the next several days and weeks and months, we'll see how our portfolio stacks up. So with that, Roger here. A little longer than the 2-minute update as usual. And the market is mixed this morning, but hey, good news. Sleep Number reported earnings last night and they're way up. So in the pre-market, last time I checked, they were up like 13-14%. And so we're looking for a big gain in our portfolio today. So with that, Roger out. If you like this information, like and subscribe to the channel. And if you like these 2-minute updates, pre-market and sometimes after market, hit the little bell down there if you're into that. So we'll see you.